A's point was that the damage that they see in consumer behavior and appetite will actually be felt less in fast casual and quick serve than some other chains.
I thought they missed the point. I mean, look, the Starbucks announcement was really terrible, but China's ascendant. Nike and Starbucks are the two ways to play China. They opened in Wuhan. Starbucks is lucking. Apparently, remember, it's no lucking. And I think that Starbucks China is going to save the day here while they figure out social distancing, and they'll figure all that out. Kevin Johnson knows how to do it. He's going to use my method, I bet, of contactless. You just come in, you don't even have to get near it. I'm working on that with Apple. I got a lot of things cooking, David. But I do think that Starbucks is a buy because of China, not because of the decline in America.
And Jim, talking about a lot of things cooking, what are you feeling about the broader market here? As we watch the S&P up over 2%, we've had an enormous rally from the recent lows. We're down now 13% for the year. I think last 12 months now we're only down around 2% or so. There are still those who believe we will retest the lows, that even as we start to open up the economy and even with all these extraordinary measures that the Fed is taking, nonetheless, those who invest are going to be stunned by just the level of or the lack of earnings from so many corporations, and we may retest. I mean, do you think that's a possibility, or are we sort of too far from that now?
I think that the news that we're getting today makes it so that you don't have to worry about the banks. If you don't have to worry about the banks, then you don't have to worry that much about credit. If you don't have to worry that much about credit, then I think it's very hard to see those lows that we saw the other day with a Nordstrom down big, Kohl's. Even an Oxy, David, that I know, that's something. And David, I'm watching Aramark surge. I mean, what is that? I mean, what is there, someone actually doing a takeover here? I think that there are things that are happening that make me feel like, you know what? We're going to get through it. America opens for business, and even GE's up. If Costco finishes up today, and they have made it so business is terrible, because you have to be in a big line, only so many people in the store, that big, terrible, disappointing second half of the month. If Costco's up today, David, then I think that people are going to say, you know what? Maybe I can't sell into earnings season like I wanted to. I know that was my
Jim, finally, just 30 seconds from the top of the hour, but oil's up 7%. Norway's going to join this OPEC Zoom call. Thoughts on crude?
Look, I think that when the Saudis are shrewd enough to go in and buy billion-dollar stakes in the oil companies, it's like inside information. I mean, obviously they're going to cut back, or they wouldn't have just bought $1 billion worth of Shell. They're pretty smart guys. It's a nice rigged market. We have SEC and
stuff like that. We're going to look for some details out of that meeting, hoping for 10 to 15 million barrel a day cut, but we will find out. In the meantime, getting the embargoed text of Fed Chair Powell's webcast. Let's get to Steve Leisman.
Thanks very much, Carl. The Federal Reserve Chairman will say in a webcast of the Hutchins Center on Monetary Policy that the Fed will act, quote, forcefully, proactively, and aggressively. He will also go on to say the Fed will act, quote, until the Fed is confident that we are on the road to recovery. As to the recovery, Powell points out that the economy was strong going into this, and he says there's every reason to believe that the rebound, when it comes, will be robust. A couple other points he makes here, that the Fed is trying to provide a measure of relief and stability to the economy, and sort of making sure that people understand the parameters of what the Fed does. The Fed is using lending powers. Everything it's put together is lending, not necessarily spending powers that it doesn't have, pointing out that the Fed can only make loans to solvent entities. And the reason why you want to hear about that is because he's saying that, hey, there are limitations to what the Fed can do here. That's why some of these programs we've been talking about the last couple hours are structured the way they are. He does talk about the acts the Fed has taken already regarding going into several parts of the credit markets that were, he says, severely dysfunction. He says there has been some improvement, or they've generally improved in the markets where the Fed has come in to try to provide stability. Finally, he does make a note make a point of noting that the virus has left, quote, a tragic toll of illness and lost lives, and concludes his speech by thanking the healthcare workers and others on the front lines. Carl?
Steve, this morning, Art Cashin says that at least in tone and qualitatively, what they've announced today reminded him at least of Draghi's whatever it takes. Would you go there?
Well, yeah, except for whatever it takes is a phrase with no meat on it. This is meat. I mean, this is really the inside of that. This is whatever it takes in action, Carl. This is all of the stuff that is whatever it takes. The ECB had gone further down after that, by the way, but now the Fed is going into these areas of corporate loans, high yield, municipal bonds, providing loans to Main Street through the banking system. Expanding its balance sheet with really no concern to the amount that is being expanded. There will be some issues on the other side of that. But my concern, which is, it's not time for this now, Carl. There will be a time when we say, wait a second, the Fed can do all this stuff in a lesser of a recession, or another time when the politicians realize that the Fed can be this piggyback. We'll have this discussion later on. Right now, all of this makes sense in the dire situation the economy could be in without this assistance.
Steve,
Carl,
let's, with apologies, let's get to the Fed chair.
We face today is different in scope and character from those we've faced before. The coronavirus has spread quickly around the world, leaving a tragic and growing toll of illness and lost lives. This is first and foremost a public health crisis, and the most important response is coming from those on the front lines in hospitals, emergency services, and care facilities. We watch in collective awe and gratitude as these dedicated individuals put themselves at risk in service to others and to our nation. Like other countries, we are taking forceful measures to control the spread of the virus. Businesses have shuttered, workers are staying home, and we have suspended many basic social interactions. People have been asked to put their lives and their livelihoods on hold at significant economic and personal cost. We are moving with alarming speed from 50-year lows in unemployment to what will likely be very high, although temporary, levels. All of us are affected, but the burdens are falling most heavily on those least able to carry them. It is worth remembering that the measures we're taking to contain the virus represent an essential investment in our individual and collective health. As a society, we should do everything we can to provide relief to those who are suffering for the public good. The recently passed CARES Act is an important step in honoring that commitment, providing $2.2 trillion in relief to those who've lost their jobs, to low and middle income households, to employers of all sizes, to hospitals and healthcare providers, and to state and local governments. And there are reports of additional legislation in the works. The critical task of delivering financial support directly to those most affected falls to our elected officials, who use their powers of taxation and spending to make decisions about where we as a society should direct our collective resources. The Fed can also contribute in important ways by providing a measure of relief and stability during this period of constrained economic activity, and by using our tools to ensure that the eventual recovery is as vigorous as possible. To those ends, we have lowered interest rates to near zero in order to bring down borrowing costs, and we've also committed to keeping rates at this low level until we are confident that the economy has weathered the storm and is on track to achieve our maximum employment and price stability goals. Even more importantly, we have acted to safeguard financial markets in order to provide stability to the financial system and to support the flow of credit in the economy. As a result of the economic dislocations caused by the virus, some essential financial markets had begun to sink into dysfunction, and many channels that households, businesses, and state and local governments rely on for credit had simply stopped working. We acted forcefully to get our markets working again, and as a result, market conditions have generally improved. Many of the programs that we're undertaking to support the flow of credit rely on emergency lending powers that are available only in very unusual circumstances, such as those we find ourselves in today, and only with the consent of the Secretary of the Treasury. We are deploying these lending powers to an unprecedented extent, enabled in large part by the financial backing from the Congress and the Treasury. We will continue to use these powers forcefully, proactively, and aggressively until we're confident that we are solidly on the road to recovery. I would stress that these are lending powers, not spending powers. The Fed is not authorized to grant money to particular beneficiaries. The Fed can only make secured loans to solvent entities with the expectation that the loans will be fully repaid. In the situation we face today, many borrowers will benefit from these programs, as will the overall economy. But there will also be entities of various kinds that need direct fiscal support rather than a loan they would struggle to repay. Our emergency measures are reserved for truly rare circumstances, such as those we face today. When the economy is well on its way back to recovery and private markets and institutions are once again able to perform their vital functions of channeling credit and supporting economic growth, we will put these emergency tools away. None of us has the luxury of choosing our challenges. Fate and history provide them for us. Our job is to meet the tests we are presented. At the Fed, we're doing all we can to help shepherd the economy through this difficult time. When the spread of the virus is under control, businesses will reopen and people will come back to work. There is every reason to believe that the economic rebound, when it comes, can be robust. We entered this turbulent period on a strong economic footing, and that should help support the recovery. In the meantime, we are using our tools to help build a bridge from the solid economic foundation on which we entered this crisis to a position of regained economic strength on the other side. I want to close by thanking the millions on the front lines, those working in healthcare, sanitation, transportation, grocery stores, warehouses, deliveries, security, including our own team at the Federal Reserve, and countless others. Day after day, you've put yourself in harm's way for others, to care for us, to ensure that we have access to the things that we need, and to help us through this difficult time. Thank you. And David, I'll look forward to your questions.
Hi, can you hear me now?
Yes.
I'm David Wessel, Director of the Hutchins Center at Brookings. I appreciate your remarks, and I particularly want to reinforce the point you made at the end that a lot of us have the luxury of working from home remotely, but there are a lot of people who don't, and they have often been forgotten in the past, and I think we all celebrate the work they're doing and the risks they're taking. Chair Powell, and I have a number of questions of my own and some that we've gotten from people who sent them in by email or via Twitter. In the past 3 weeks, more than 15 million people have filed initial claims for unemployment benefits. That's huge. We all know that the second quarter is going to be awful, but I wonder if you could help us look ahead. You and your formidable platoon of economists, what do they see for the rest of this year? You talked about a robust recovery. Do you expect that to begin this summer or fall, or do we have to wait longer for that?
We have terrific economists with different specializations right across the Fed, and it's really a great honor to work with them. And if you ask them today what their expectation is for the economy over the course of the rest of this year, they will tell you that it really depends on the path of the coronavirus. How quickly will it spread? How quickly do we get it under control? How quickly are we able to reopen the economy with confidence? People can go back to work knowing that it's safe. Businesses can reopen knowing that it's safe. So that's really the thing. These are not typical economic questions that our great economists are practiced and skilled at answering. So they'll tell you that. And so I would say, generally, my expectation is that the second quarter will be a very weak one. And that's because businesses are shut down. Workers are either working from home, or they're furloughed or laid off, or they're just, the businesses that they work at is closed for the time being. So we do expect to see a very low economic output and big increases in initial claims for unemployment and in unemployment during the second quarter. When the virus does run its course and it's safe to go back to work and safe for businesses to open, then we would expect there to be a fairly quick rebound as people do go back to work and start resuming normal levels of economic activity. I think most people expect that to happen in the second half of this year after the second quarter, which of course ends on June 30. To try to be precise about where that would be, I don't think that would be appropriate. I will just say that it does depend on people staying home, staying healthy, doing everything we can to get the virus under control. The more we do that, the sooner it will be safer to go back to work.
Thank you. So as you noted, the Fed has cut interest zero. You've bought hundreds of billions worth of treasury bonds and mortgages. You've launched an alphabet soup of lending programs, including some new ones today for state and local governments and mid-sized businesses that you say could lend up to $2.3 trillion. Is there any limit to how much money the Fed can create, how much it can lend without having some unwelcome side effects like inflation or asset price bubbles?
So I'll just say that these programs that we're using under the law, we do these with the consent, as I mentioned in my remarks, with the consent of the Treasury Secretary and with fiscal backing from the Congress through Treasury. And we're doing it to provide credit to households, businesses, state and local governments as we are directed by the Congress. And we're using that fiscal backstop to absorb any losses that we have. And what we've been doing is looking for places that are very important to the real economy, things that really affect people's lives and economic output, and where credit to those parts of the economy has broken down. And those are the ones I've mentioned. And so that's essentially what we're doing. And we can keep doing that as long as those needs arise. Our ability to do that is limited really by the law. We have to find unusual and exigent circumstances. The Treasury Secretary has to agree. And we are using this fiscal backstop. But there's no limit on how much of that we can do other than that it must meet the tests under the law as amended by Dodd-Frank.
But isn't there a risk that with all this money coming out of Congress, the money that we're lending, that we'll end up with something that we don't like, as in more inflation than we like or asset price bubbles?
So inflation has been an interesting phenomenon. Back when 12 years ago, when the financial crisis was getting going and the Fed was doing quantitative easing, many people feared that the increases in the money supply that would, as a result of quantitative easing, asset purchases, would result in high inflation. Not only did it not happen, the challenge has become that inflation has been below our target. So that is globally the challenge has been inflation below target. And honestly, it is not a first order concern for us today that too high inflation might be coming our way in the near term. Far from it. There are certainly, I would say, these are programs that we're developing at a high rate of speed. We don't have the luxury of taking our time the way we usually do. We're trying to get help quickly to the economy as it's needed. And I worry that in hindsight you will see that we could have done things differently. But one thing I don't worry about is inflation right now.
A number of people wrote questions that go something like this. Think of somebody who works at a small restaurant. She's lost her job. The restaurant's closed for how long, really nobody knows. All the things that you're doing, how do they help people like her, the owners of that small restaurant, and the millions of people like her in that position?
So she sounds very typical of what many people are unfortunately enduring at the moment. And I would say the most important thing that she can do is to stay home and stay healthy. The more people do that, the sooner we will get control of the spread of the virus, the sooner we'll be able to go back to work. It's also important, by the way, that our healthcare authorities develop a plan for that to happen in a careful way that doesn't result in another outbreak, and then we have to go back to square one. In the near term, the biggest relief that she will get is probably going to be from the expanded unemployment insurance under the CARES Act, which I think added $600 per week for people's unemployment insurance. She'll probably find that it's hard to get access to that right away because there's so many newly unemployed people that there are backups at the unemployment offices. But that money she's entitled to that money, and she will get that money. It may take a few weeks longer than it should. So what is the Fed's role in this? Our role, as I mentioned in my remarks, is really to try to provide some stability and some relief during this period when the economy is partly shut down. That involves keeping interest rates low. So if she has a mortgage or credit card debt, she'll feel lower interest payments from that. Also, as you mentioned, David, we've used our tools to keep the financial markets functioning. That's going to avoid significant further damage to the economy. And really, the most important thing we can do is, while providing stability during this period, will be to support a robust recovery when it does come. That's really what our tools are most important for.
You mentioned that Congress has done quite a bit. You mentioned correctly that you don't do taxes and spending, Congress does. But everyone, including members of Congress, look to you for advice. In your judgment, do we have to do a lot more on the fiscal policy front to respond to this crisis?
So I'll just stress that we don't, as you know, we're not responsible for fiscal policy. We don't give public advice to Congress on fiscal policy. I will say that, as I mentioned in my remarks, in many cases, what people really need is direct fiscal support rather than a loan, and what we can do is loan. So there's a big need for fiscal policy. I do think I hear many voices on both sides of Capitol Hill and in both parties talking now about further support. I do think that's likely to be appropriate. They will have to decide as elected officials what that might be, but you already hear, for example, further funding for the small business SBA loans, and also perhaps more direct funding for the states and for hospitals. Again, not our job, but I would see that as more likely than not to be needed.
And a good idea.
Yes, absolutely. I would say broadly, people are undertaking these sacrifices for the common good. We need to make them whole. To the extent we have the ability to make them whole, we should be doing that as a society. They didn't cause this. Their business isn't closed because of anything they did wrong. They didn't lose their job because of anything they did wrong. This is what the great fiscal power of the United States is for, is to protect these people as best we can from the hardships they're facing.
Congress has allocated in the CARES Act $450 billion to backstop Fed emergency lending. If I did my arithmetic right, today you used $195 billion of that for the various programs you announced this morning. What are your priorities for the rest of that money? How do you think about how you'll use it and what you'll have to use it?
So our priority really for all of it is the same, and that is what's happened is in our big, complicated economy and financial markets and banking system, we rely on those who have funds to lend through various channels to those who are borrowing. And what happened when the spread of the coronavirus around the globe became clear is investors all over the world had really struggled to assess what that meant for the economy. And so they pulled back from other kinds of investment and really went to the safest short-term investments like T-bills. And the result of that was that many parts of the capital markets and lending more broadly stopped functioning. And that is exactly the situation that our emergency powers are meant to address. So we have moved in, and as I mentioned, our priority are those areas of the markets that are most fundamental to supporting the real economy. And you see the programs. We've now announced, I think, 9 different facilities, and those really are the priority areas where we thought that help was needed. As we identify other areas, we won't hesitate to move into those areas. In addition, we may find that some of the programs we've announced need adjusting and need to be larger, or didn't need to be as large as we thought, or need to be changed. We're going to be watching all of that and very much willing to adapt.
There is, I think, a consensus that one mistake made during the global financial crisis a decade ago was that banks were allowed to deplete their capital by paying dividends for too long. Now, several big banks have voluntarily suspended stock buybacks to preserve their capital. I'm curious why it hasn't suggested or directed them to suspend their common dividends as well.
Yeah. Maybe I'll start by saying that businesses distribute earnings really to their shareholders through buybacks and through dividends. And that's just a way of saying that that the owners may have better use for those funds than the business does. It's a perfectly normal thing in our capitalist system. And our largest financial institutions do about 70% of those distributions through share repurchases. All of our 8 largest, most systemically important institutions have stopped distributions through that channel, as have a number of the large regional banks that account for a big part of the banking system. And that's a good thing. They haven't stopped dividends. And in my way of thinking, I don't think that's something that needs to be done at this point. I think our banks are highly capitalized, far more highly capitalized, with more high quality capital than they were before the financial crisis. And we'll be watching to see how things evolve, but I don't think that step is appropriate at this time.
I see. One of the things that distinguishes this period, which is pretty extraordinary, is what's going on in the mortgage market. We've seen a sharp spike in delinquencies. It's hard for people to buy. It's even hard for people to refinance mortgages. There's questions about the mortgage servicers. Do you think there's steps that need to be taken now by the government, broadly defined, to make sure that a mortgage crisis doesn't make the economic recovery slower than need be?
Well, so a couple of things. First, I think the CARES Act does provide a moratorium on payments for some time for some mortgage holders. But you're absolutely right. The mortgage market is at the very center of our economy and very important for the real economy. That's why we bought so many mortgage-backed securities at such a historically aggressive pace over the last few weeks. We feel like the mortgage, that market, which is where an awful lot of individual home and other mortgages wind up, is now functioning more properly. We're watching carefully the situation with the mortgage servicers, and I will just tell you that we certainly have our eyes on that as a key market that does support households and consumer spending, really, which is of course 70% of the economy. So we'll be watching that carefully.
Chair Powell, I understand that a few minutes ago, the Treasury Secretary, Steve Mnuchin, said he thought the U.S. economy might be ready to reopen by the end of May, as soon as the president feels comfortable with the public health stuff. Does that seem right to you?
You know, we don't, this is not a judgment that is assigned to the Fed to make. And that's a judgment that has to be made, I think, starting with health officials. I do think it's time to have a serious public conversation and a lot of analysis about that. You know, we need to have a plan nationally for reopening the economy. We all want it to happen as quickly as possible. We all want to avoid a false start where we partially reopen and that results in a spike in coronavirus cases, and then we have to go back again to square one. We all want to avoid that. So we're not experts in that here at the Fed. I would really rely on the medical experts principally, and then that will be a decision for really other parts of government.
I'd like to think a little bit about like on the other side here. What are you going to be looking at to decide whether it's time for you to pull back these lending facilities and maybe begin to tighten again?
You know, as you've noticed over the years, David, we tend to move gradually and predictably. We think that's a good way to do things. So I think we'll be looking to see, we'll be looking to see that the economy is well on the path to recovery. We'll be in no hurry to pull back on our asset purchases or on these programs. They're tentatively scheduled to stop lending on September 30th. If they have to go longer than that, of course they will. So I think the thing we'll be looking for is to make sure that the economy really is on a solid footing before we start pulling back. And then, as you know, when we start pulling back, we do so very gradually. If you think about the way we ended our quantitative easing back in 2013-14, we did it over the course of a full year. You can fully appreciate and expect that we will follow that playbook of well telegraphed in advance, quite gradual moves, and we won't start them until it's time to do so, which would be a time at which we are confident that the economy is on a solid footing again.
A number of people have asked whether you think you'll rely on a cap on short-term interest rates, a yield curve control kind of thing, when we come out of this thing. Have you considered that? So
we, of course, we've done a lot of thinking about what monetary policy might look like over the coming months. For now, though, two things. First, we think our monetary policy is just in the right place. We've got rates at zero, and we've said that we'll hold them close to zero, that is, until we are sure that the economy has weathered the storm and is on the way to recovery. So that's, we think, exactly where that should be. The principal focus now is not on adjusting what we see as quite an appropriate stance of monetary policy, at least for the next few months. The principal focus is on these lending programs and making sure that credit does flow in the economy. We saw what happens when the credit system breaks. It can really inflict much greater damage on the economy. We're doing everything we can to avoid that, and we'll continue to do that so that credit is flowing, households, businesses, state and local governments, as requested by Congress. And that's really the main focus now. All of those things that about monetary policy, of course, we're thinking carefully about what that might look like in the future, but they're not, something we're currently, thinking would be appropriate.
Are you at all worried about the Federal Reserve, which is, after all, unelected officials making decisions about who can borrow and who can, and what credit rating is eligible for your loans and where you're not going to lend?
So this is an area where during the global financial crisis that ended in 2010, let's say, the Fed really made those decisions, although did so with some consultation with the Treasury Department. One of Dodd-Frank's innovations was to say that we could only use these extraordinary powers with the consent of the Treasury Secretary. And I think that's actually a wise decision. Decisions of this magnitude really there should be some accountability, at least, for those who are elected by the public. We are not elected by the public. And that is the administration in the form of the Treasury Secretary. I think that's actually a healthy thing, that there be some connection to elected officials. So I think that's a wise move on the part of Dodd-Frank. So we don't make, the second thing I'll say is we don't make decisions about individual firms. We're only allowed under Dodd-Frank to have programs of broad eligibility, meaning classes of borrowers. Any borrower that meets the eligibility requirements for one of these facilities can take part in the facility. We're not going to be picking this firm but not that firm. It's broad eligibility, so there won't be that. I'd also say there are overlapping spheres here. The Fed has complete authority over monetary policy. Treasury does fiscal policy with Congress, but financial stability is really something where we both have a stake and both have authorities. The Treasury Secretary chairs the Financial Stability Oversight Council, for example. So we do work closely with them on these facilities, and I'll say that's been a very productive relationship.
And finally, I wonder if you could speculate a little bit about how the economy will be different when we come out of this. We'll have a lot more debt, that's for sure. Do you think that we'll be saving more? Do you think our way of life will change? Do you have thoughts on that?
Our main focus is on the near term, and that's really our intense focus. But these are great questions, and my guess is that behavior will change. It won't change quickly. People will start to go back to movies, to theaters. They'll start to travel, and they'll gain confidence that it's okay to do so. And that process can be a fairly short one, but I think it'll be, at the beginning, it will certainly be gradual and tentative. Will there be longer run changes in our behavior? I don't know. That's a great question. We'll have to see.
And I think a lot of people are scared now. This is not something that any of us have lived through in our lifetimes, a pandemic like this that's caused the economy to stop and people will be afraid of interacting with their neighbors. I think people want to know that our leaders, people like you, are confident that we can get through this. So I want to give you this opportunity to, if you like, to reassure people about what lies ahead.
Thank you. So, David, I would say this is going to be and is a very difficult time for many, many people. People are getting sick. Their loved ones are getting sick. People are getting furloughed and laid off. People who started great businesses are seeing them shuttered. I wouldn't want to say anything that diminishes the suffering that people are feeling at all. It's going to be a tough time. But if the government continues to give people the support that they need, that includes us, that includes Congress, other parts of government. And if people stay home and stay healthy until it's appropriate to go back to work, and if the healthcare policy experts devise a plan for a good way to go back to work and reopen the economy, if we do all of those things, there's every reason to think that we can be back on the road to a recovery fairly quickly, and that can be a robust recovery. I actually thought Chairman Bernanke said it well the other day when he said that if we do those things, you'll be looking back on this and you won't see much, only modest effects, I think he said, on the economy from this event. And I think that can be the case if we do the things that I mentioned.
Well, as they say, from your lips to God's ears. Chairman Jay Powell, thank you very much for your time today. I thank everybody for watching and the very good questions we received. And we wish you all a very safe next few weeks as you continue the important job of steering our economy through this terrible storm. Thank you very much.
Thank you, David, and thanks, John.
And our thanks to David Wessel of Brookings and Fed Chair Powell for a remarkable live webcast complete with Q&A. Among the highlights, David and Steve Leisman, Q2, as expected, likely to be very weak. Not really taking debate on inflation, saying it's not a first-order concern for us today, far from it. Saying further support is likely to be appropriate, both potentially by the Fed and then at Congress for fiscal measures, Steve, saying that's what the great fiscal power of the U.S. is for. And then saying bank dividends, I don't think that step is appropriate at this point in time. Your thoughts?
You know, you're absolutely hitting the high points, Carl, but I want to go back and sort of give a topical assessment of what just happened there. It was very important in several respects. Fed Chair Jay Powell was just giving policy there in the form of forward guidance. To me, the key answers were to the questions of how long does this go on? How much more will you do? When will you withdraw it? What's going on there is the Fed is announcing this morning a program of $2.3 trillion. That's one policy. Another policy is forward guidance, telling the market how long this will be in effect, how much more you'll do. So I highlighted some comments that he made. He said, Carl, there's no limit on how much we can do as long as it meets the tests of the law. That tells the market we ain't done yet. Going on further, when will you withdraw this? He goes on to say, let me just find this. Well, we're well on the path to recovery. We will be in no hurry. We'll make sure the economy is really on solid footing before we pull back. We will follow the old financial crisis playbook to do well-telegraphed moves in advance. So Powell right there, using that time period to lay out another essential leg of the stool of Fed policy, low interest rates, trillions of dollars of loans to the economy, and very important forward guidance that tells markets this thing is going to be around for a while and it's not going away quickly.
Yeah. David?
Yeah, I mean, Steve, you know, when he talked about reopening the economy, I thought it was interesting, and Carl, of course, saying that we do need a plan. We heard from Secretary Mnuchin this morning in answer to Jim's question, indicating certainly that there were thoughts now turning to when and how. The Fed chair didn't offer a lot in terms of his thoughts about how you do it, but he certainly did indicate he hopes it's being focused on.
I thought it was very important what he said. It was a little bit of a phone call to the president there, right there. We need a plan for the rebound. I thought that was critical. I also think he made an important distinction between, you know, the economists and what they're doing and what the epidemiologists, the virologists, whatever they call them over there, how much more important that is. That, you know, he can bet on a second half rebound, but he can't call it. It's going to be up to the doctors and the health officials. They can only deal with the plan that's dealt to them. He did think about, you know, whether or not we're going to change our behavior, but the Fed has to deal with the programs given to him by public health officials and deal with the reality of this virus. It's really forced, David, people to be into expert places. I mean, you know, the guys on Wall Street that are out there trying to look at contagion rates and death rates and hospitalization rates. These are areas of expertise that are critical to the economic outlook and the investment outlook that are well outside anybody's area here they ever thought they'd have to deal with.
Without a doubt, and in many ways unknowable, because they also do rely actually on human behavior, on people following the protocols that have been put in place right now. And it's just very, very difficult to truly to know. And, you know, even if we do manage, as we all hope, to contain this outbreak soon, there's always the possibility that it will happen again, that we are not in a position necessarily, certainly not going to have a vaccine for some time. And so what will the economic impact be then, Steve, when you have a recurrence in certain areas? Will you have to shut down again? Will we be better suited to sort of keeping the economy open if, in fact, we get a recurrence? So there are so many questions, as you point out, Steve.
Yeah, Dave, I just want to give you the one quote that was another bit of a memo to the president from Powell. he said, we need to have a plan for reopening the economy. We all want to avoid a false start. And I think that was a very important comment that you're alluding to right there that was said. It could be really worse if we came back, when we had to go back and do it again. So I think that's Powell maybe talking to the president and saying, take your time here, Mr. President. Let's not blow the initial opening of this.
To that point, Steve, Reuters has a piece up now that the Economic Task Force at the White House will include Mnuchin, Kudlow, and others, that the announcement of that task force focused on the economy could be announced very soon, according to a senior administration official. If you missed any piece of the Powell webcast over the past half hour, take a listen.
As a result of the economic dislocations caused by the virus, some essential financial markets had begun to sink into dysfunction, and many channels that households, businesses, and state and local governments rely on for credit had simply stopped working. We acted forcefully to get our markets working again, and as a result, market conditions have generally improved.
All right, Rick Santelli, we got to get your thoughts as well this morning on this.
Well, I'll tell you what, Carl, it's a tough one for me because there's no arguing with the fact that the Fed is the only entity, in my opinion, especially in an election year, that's able to deal with this in the way it necessitates, considering how much of the economy is shuttered, the cessation of activity, the knowledge that we're probably not going to get very good earnings. Listen, if there's an earnings surprise this earnings season, it's that there are earnings. That would be the surprise. With regard to the markets, here's what I find fascinating. There has been very little market movement since the announcement prior to this really interesting back and forth with Mr. Wessel and, of course, Chairman Powell. Interest rates aren't nearly as high as I thought they would be. The dollar index isn't nearly getting as hard as I thought it possibly could be. And I think maybe the reasons for that are very large. And the reason is because the market fully expects all the players you're talking about trying to handicap and use the same models in finance that they use for mortality rates and, garbage in, garbage out. None of these models seem to be giving us very accurate results. But in the end, there's a very big confidence in investors, domestically, globally, that people like Chairman Powell, central banks and governments are going to do whatever they can to stop this in its tracks and buy their economies time. And I think that is the assumption that's embedded. Until we see that assumption either taken away or, in this case today, enhanced, that's the only real relevant, I think, information that we're going to see the markets give us. And the fact that they're trading kind of steady with the last couple of days' efforts of the equity market to do better, that's what's in the equity market and the investors' minds, that these programs and what Steve Leisman accurately brought up, the finality of when these programs are up, the forward guidance embedded in there is still, at this point, enough to overwhelm the notion there's going to be very little economic activity in the very near future.
Right. On a day, literally at the same time, we got jobless claims above 6 million for a second week, Rick. Mike Santoli, embedded on top of this are more headlines out of OPEC. Reuters citing two sources that the cut that they're discussing could be as big as 20 million barrels a day. And for a moment there, the S&P was having its best week since the 70s, and the Dow its best week since 1938.
Yeah, I mean, obviously, the real push higher, I think, in the markets this morning came when it was revealed that the Fed would also be backstopping the high-yield debt market. Energy going up also works in that direction. So if you think about what really was getting priced in when the market was rushing to those lows, it was a very high probability of this echo effect of the shutdown being wear and tear on corporate balance sheets, a default cycle, basically unchecked insolvencies across parts of the economy. And I think that in stages, the Fed has essentially cushioned against that likelihood. And the stock market is pricing out some of those bad scenarios along all these fronts. So that to me would be the read. I mean, I think if we were set up before we got this Fed news today for maybe a digestion phase, we had this big rally the week you talk about, Carl. So it makes sense, I think, that you're essentially just kind of going up the curve of having some confidence that businesses can be bridged through this period. And that to me is most of what's happening. Also, the way the stock market acted on the way down, I kept remarking that it really wasn't kind of obeying or really paying much attention to these obvious places to stop and take a breather along the way down. It was just really a liquidation. And now we've actually almost had an equal and opposite move to regain about half of those declines. So it's been pretty remarkable in both ways, just because the range of outcomes was so wide and on one end so scary that it did cause that rebound effect.
All right, both in the short term and the near term. In terms of the short term range of outcomes, let's turn to Brian Sullivan and ask whether or not, Brian, you're hearing numbers like the kinds Reuters are citing about production cuts.
I have not heard 20 million, Carl. I mean, those are big numbers, and maybe it's being floated by the Russians out there to show some goodwill, perhaps. I mean, the numbers, and I just published a piece on CNBC.com. It's aggregated from all the research out there, OPEC, our own numbers. Really, you're probably looking at maybe 11 to 12 million barrels a day when all is said and done, because here's why, Carl. The Russians have said they'll cut 1.5 million barrels a day. That's about 14% of their production. Everyone has made it clear that they want sort of proportional production cuts. So let's round it up to 15%. If everybody, the U.S., Canada, Norway, OPEC, G20, if they all cut 15%, you're probably looking at about 12 million barrels a day, maybe a little bit more. I think this is just truly amazing. The fact, Carl, that we're talking about a production cut that the world has never seen in terms of size and scope. Yes, oil is up, but it's up to 27 and change. It started the year at 60. We're 30 million barrels a day oversupplied. This is not a rescue of oil and gas. This is to buy one thing, guys, and that is time. Slow the tank fill before everything is filled with oil and there's literally nowhere to put it.
Hey, Brian, it's David. We had production cuts as well, didn't we? I mean, we went from, 13 million barrels a day to about 12.6 or something like that most recently?
Yeah, we do. And David, I think what's amazing about watching the U.S. side of the story is that we don't have an OPEC, right? We don't have a national producer that somebody could just say, hey, shut the taps off. We have 9,000 producers in total. So there's no way to get everybody on the same page. The president tried to get the big ones, obviously, at the White House last Friday. What's going to happen, David? And I know you know this space very well. There's a natural drain rate, right? I drink your milkshake. Eventually, you just kind of suck all the oil out. If you don't put new wells into production, then our production numbers are going to go down naturally. So will the U.S. be part of any deal to cut? No, but through natural attrition, billions in capital spending cuts, the U.S. decline rate will happen. I think the Saudis were probably very happy to see Exxon's, huge capital spending cut projections, because what that says to them effectively is they're cutting, but it's just not like everyone got into a room or a virtual room together and made a deal.
Yep. Yeah, like so many big announcements this week. It feels like it's a long time ago, but it was only a couple of days ago that Exxon cut its capex, I think, from 33 to 23 billion, taking $10 billion out. Brian, thank you for the update on oil. Steve, I want to get back to you on this momentous day. Of course, we heard from Fed Chair Powell. We also got at around 8:30 this extraordinary announcement from the Fed: $600 billion in loans through the Main Street lending program. They're levering Treasury $75 billion, 8-to-1. Municipal bond assistance, the municipal liquidity facility, up to $500 billion. They're levering Treasuries $35 billion, 14-to-1. And, of course, something we pointed out a number of times, also moving into the corporate bond market, $75 billion from Treasury, levered 10-to-1, although when they buy high-yield bonds, they'll only lever at 7-to-1. So much to keep track of, Steve, this morning involving the Fed.
Who's better than you at it, David? I mean, I actually had a couple questions I had. One was for Sully. The first one was this whole issue of how and in what form will the oil and energy companies be able to come to the Fed window. That remains unclear. I didn't know if Sully was hearing anything about that. It's something that we know a bunch of senators want to be able to make them available to do that. Big question in the oil business. Were these companies that were failing even before coronavirus came along? Remember, oil prices were already down. There was always issues with their debt. And now, of course, they're in much worse shape. So that's a big question we're following. Second question was for you, David. Does CLO backing mean that private equity-owned businesses are now going to be able to go to the Fed's window? I'm still trying to figure that out. The third thing I want to point out is Powell saying that as we've done in other, we won't hesitate to move into other areas where they may find there is needed. So I don't know, David, you're the expert on private equity, but that's a big issue as to whether or not some of the companies that aren't so obviously popular in terms of receiving aid. Our poll yesterday showed hospitals, small businesses, restaurants. Yeah, the public's way behind that. But you get into airlines, oil companies, Boeing, that's where the public support for that kind of relief trails off.
Yeah, well, as you know, Steve, private equity was notably left out in many ways of the the relief pack, the CARES package coming from Congress, because they said even if one business has fewer than 500 employees, or this one or that one, we add them all up. And so their employee obviously ranks were far above 500 for most of the big private equity firms, far above it. They're still not quite dealing here, Steve, with the businesses that are 10,000 employees and above, or $2.5 billion in revenues and above, and yet are not investment grade. Now, they're being helped, and energy is being helped as well by what's going into the high yield market, by the ability of the Fed now to buy high yield bonds and stabilize in that area. So that's important. As well in CLOs, as you point out, collateralized loan obligations. Banks make loans, and then they are obviously put all together and sent out to investors as they are securitized. That also becomes important as well. So, Steve, there are ways that they are potentially going to be able to aid those companies, but without the direct lending that we're seeing in some other areas.
All right, here's what we'll do. I'll read the term sheet. You call your PE buddies, and we'll figure out whether or not they're going to be eligible for what they're eligible for and how much. I think that's a key area. One other point I want to make, David, there was somebody who in the last crisis said to me, called himself a reluctant hegemon. And you can imagine who that person was. I think you probably know him. I think what I hear from Powell is he was a guy who was reluctant to come in and do all this stuff. But once you flip that switch, I think he's all in now, so to speak. When I hear him say this is what the great fiscal power of the United States is for, to protect these people and these people who are undertaking, he says, sacrifices for the common good, we should make them whole. I don't think there's any doubt that, somebody wrote me a note that said, they're doing a runaround on the Federal Reserve Act. I think they're going to go as far as they feel they legally can here to inject as much money as possible to stabilize the system.
Meanwhile, guys, we're getting some news in the ongoing short-term battle between McConnell and Schumer Pelosi. For that, we'll turn to our Eamon Javers. Good morning, Eamon.
Yeah, good morning, Carl. It's no deal in the United States Senate. Mitch McConnell pushing to add an additional $250 billion to that Paycheck Protection Program for small businesses. He's concerned that there's so much demand for that program, it could be running out of funds sooner rather than later. But Democrats blocking that move this morning. They need unanimous consent on the Senate floor in order to get this done because there are so few senators around. Democrats stepping in saying, no. What we want is a much bigger program, an additional $250 billion for states, localities, hospitals, all sorts of other entities. The Democrats envision a much bigger program. They don't want to just pass what's called a clean bill, just focused solely on this small business issue. So they've stepped up to block that. That means no deal, no replenishment of that fund today. We'll see where this goes. Carl, my sense is this is enormously politically popular. There's going to be some jousting over it, but in one form or another, whether it's in a small bill or as part of a larger bill, this plussing up of that small business fund is going to get done at some point here from Congress.
Yeah, Eamon, your point also on Twitter, at least, was that, the discussions we were having watching the Democratic primaries, Andrew Yang and MMT, as a notion, are beginning to get baked into at least some politicians' strategic worldview.
It's so interesting to watch this happen. You see Andrew Yang on Twitter now talking about the direct payments to Americans. He'd like to see those continued during the length of this crisis. Remember, he campaigned on this idea of a $1,000 check to Americans generally. That idea was in the outer edges of the solar system during the presidential campaign. Andrew Yang made a lot of gains for it, theoretically, during the course of the campaign, but was always viewed as an outlier. Now, though, I think Americans and American politicians are getting much comfier with the idea of sending checks directly to Americans. And I think that affects our politics in terms of, what happens on the other end of this. Does the idea of universal basic income become something that's in sort of the mainstream debate anyway, even if it doesn't get done? Is it moved more central to the focal point of the debate? Whereas, just a couple of months ago, this was viewed as just the edges of reality in terms of what was politically possible in this country. Now, all of a sudden, that's changing, Carl.
Yeah, it's remarkable, Rick. The puzzles that the markets are having to solve in real time, the near-term public health puzzle and crisis, the near-term economic puzzle and crisis, and then these long-term pillars, these long-standing notions of what the government owes you are going to be changing and discussed for months to come.
Yeah, I see exactly what you're saying, but I'm not sure I agree with how it turns out. I think in the here and now, many are giving the big policymakers all the room they need, all the runway they need. But I certainly disagree with the comment that on the backside of this is going to make MMT and all of that much closer, maybe checks from the government, something that's a reality. No. We're not giving anybody anything here. We are compensating for the great cessation of the economy. The economy's closed, and we're doing everything we can via policy in the gray of charters to try to dance in place and make sure everyone is compensated in a fair way. But when we get on the backside of this, if anything, the discussion's very quickly going to turn to the deficits we've racked up. Not that we shouldn't have racked it up, but I think this notion of ongoing checks to people is not going to survive. As a matter of fact, I think the size of the deficit and the thought process on the backside of this will actually go the other way.
Rick, I think a lot of people can see where you're coming from. So, Mike, tactically, where does it leave us going into what we know will be a long weekend? We used to talk about Corona Fridays being net bearish.
Yeah.
Can we extend that to a Thursday going into an Easter holiday?
It seems like that pattern had been broken a little bit. We had the down Fridays and the down Sunday futures. It seems like we've interrupted that. I think what it does, though, is it has people asking, is that enough for now in terms of this rally? We regained half of what was lost in the entire move lower. You've also, as I was saying before, if you priced in this kind of really headlong rush toward a corporate balance sheet crisis along with the economic shutdown, you've now priced that out again, and we're at a logical point to kind of calm down a little bit here. And also, we have to ask if just what now has to get better in a relatively quick way in terms of the health stuff and the pathway toward reopening. What's priced into that? So I think the market looks fine. What's really interesting going on right now is within the market, all the big, safe, secular growth stocks are getting sold. Tech is underperforming, NASDAQ underperforming, and they're picking up the beaten up stuff that was priced for extinction and is very levered. So that seems to be one of the themes that's going on. Maybe at an index level, it might be a good area to pause, but there's a lot happening below the surface.
Yeah, Mike, the one security that the Fed doesn't appear ready to buy is a stock.
Yeah.
I guess at this point. They're buying high yield bonds, which I kind of thought we'd never probably see. Sure. But again, we are in extraordinary times. High yield sometimes is seen as a proxy for the equity markets. And of course, the high yield index is up dramatically this morning. There may have been a number of people shorted as well. But to your point, that area seems to be benefiting.
Absolutely. I mean, look, high yield is right adjacent to equities along the capital structure and on the spectrum of assets that people view. And so they get repriced. Stocks get repriced along with corporate credit and high yield. So it makes sense that stocks would be a net beneficiary of it. Probably not even necessary to entertain the idea of the Fed buying stocks. I'm sure they're very, very reluctant to do that. And right now, again, it seems like this is probably enough, at least to cushion against some of the worst fears. I don't think it really does anything for growth, right? And so that becomes the equation you have to figure out next is the nature of the comeback and the rebound and the corporate profit situation. But that's not today's business.
Yeah, although it will quickly become our business once we start getting these Q2 earnings reports in the coming days. Guys, we'll take a quick break. A good discussion coming out of the Powell webcast. Dow session high was up 564, currently up 427, and Squawk Alley will start in just a few minutes.
You love TuneIn for live breaking news from CNN, MSNBC, Fox, CNBC, and more. But when you can't catch your favorite show as it airs, it might just be a click away as a podcast. Search your favorite news station to explore all the on-demand news shows on TuneIn.
A lot of people aren't aware that TuneIn lets you listen to the same terrestrial stations that you pick up on your FM AM dial, except you can hear them from anywhere. To see all the stations broadcasting in your area, find the local radio section on the home screen. Keep it local with TuneIn.
Keep up with everything happening in the wild world of pro wrestling with a TuneIn podcast. For expert analysis straight from the WWE to Steve Austin's no-holds-barred conversations with wrestling's biggest personalities, search sports and scroll down to the world of wrestling to listen.
Get social with TuneIn. Follow TuneIn on Facebook, Twitter, and Instagram to discover what's happening in the app and around the world. Be the first to know about upcoming games and the hottest new music. Follow @TuneIn and always be in the know.
With so much of our lives spent at home, are you listening to TuneIn all the ways you could be? With compatibility on your phone, tablet, computer, sound system, smart speaker, smartwatch, smart TV, game console, and more, chances are, if there's a time and a place you'd like to hear the TuneIn audio you love, there's a way to hear it on all the devices in your life. Go to TuneIn.com to discover all the ways you can listen.
This is Dr. Sanjay Gupta. Join me for CNN's new podcast, Coronavirus, Fact versus Fiction. We know you have questions, and we want to help you find answers. And send me your questions on social media at Dr. Sanjay Gupta.
Make sure to search and listen on TuneIn today.
Hey everyone, it's Tremaine Lee, MSNBC correspondent and host of the new podcast, Into America. In our latest episode, Republican giant and longtime Senator Lindsey Graham is for the first time ever facing a real challenge to paying for car insurance.
Good Thursday morning, everybody. Welcome to Squawk Alley. I'm Carl Quintanilla with Morgan Brennan, John Ford, coming to you live from various locations today. Just an astounding, historic opening session here for markets on this Thursday as we watch all kinds of data come in. University of Michigan and claims, watching Congress and trying to put together an addition to these SBA loans. The Fed with $2 trillion in additional liquidity measures announced, and then this webcast with Fed Chair Powell talking about everything from the Fed's future moves to inflation to bank dividends. John Fort, for a moment there, actually I think still Dow's on pace for its best week in several decades and the best week for the S&P since 1974.
Yeah, all relatively speaking, relative to where it has been. And, I'm looking at stats over where certain stocks are relative to where they were 3 months ago. A few names, interestingly, are higher over the past 3 months, Microsoft being one of them, up 1.7%. Some other larger names that people would recognize include Amazon, which is about 7% higher over the past 3 months. So there's some interesting things going on here based on expectations. People are braced or were braced for the worst. You have to wonder whether we're correctly braced right now. But the markets, of course, continue to trade, and any one day you can't put too much stock in. Right, Morgan?
Yeah, that's right, John. And it is pretty incredible just to see what has bounced this week. I think both Bob Pisani and Mike Santoli have touched on this throughout the morning. The fact that we have seen these mini rallies, because keep in mind, these stocks are still trading at such incredibly depressed valuations versus a month ago, whether it's in retail, whether it is in the airlines, some of these other hard-hit names that have basically, in some cases, seen revenues dwindle down to near nothing right now, and major furloughs taking place. The other thing to keep an eye on is actually the high-yield bond ETF, HYG, and also the junk ETF, Spider, Bloomberg, Barclays, HY bond ETF, JNK. We're seeing those jump as well today because of some of these Fed actions, which include now basically buying into and helping support U.S. high-yield corporate bonds. So really Talk about taking all the tools out of the chest. It's causing some strategists to now circulate notes today asking what could potentially be next for the Fed. Is it going to be something like buying into actual equities?
Well, guys, we are glad to have back on our air Art Cashin, Director of Floor Operations at UBS Financial Services, along with our own Bob Pisani. Art, we have missed your guidance and wisdom over the past few weeks as you recover from an accident, but it's great to have you back. Let me just start off by asking you about this historic Fed move. And as you said in one of your notes this morning with Powell on the tape, the game is now on the table. What do you mean?
Well, it's the Fed has stepped in. This is the latest equivalent of what Draghi did with the famous whatever it takes. As you recall, that was such a broad enough offering that the European bond markets and later the U.S. markets all took off. And I think the Fed is in there showing the fact that it's active. They are concerned. This is a unique recession that we are either in or on the verge of, caused by the coronavirus and the fact that people, interestingly, this is not a normal recession, if you would. This is a self-imposed recession by the government, by ordering bars to close, restaurants to close. People are being laid off, not because their business was slowing down, but because the government wanted to prevent the chance of infection. So that makes this slowdown all the more unique than anything we've seen. I was a little nervous. I don't know if it was Morgan. Somebody mentioned that the Dow was having its best week since 1938. My recollection was it was a little bit of a topping process that week, but I'll have to go back and look it up. For now, the Fed coming in open-ended has given the market a breath of fresh air. We traders coming in this morning had looked at what looked to be a 50% pullback from the lows and thought the market might begin flattening out here, but we got a second breath from the Fed.
Art, how do we know what the market's valuing right now with so many companies having pulled guidance? And do you think stocks are pricing in and a reopening of business, literally the doors reopening, or are they pricing in the doors opening and then people also coming inside?
Well, I'm hearing people optimistic about it, no less than Howard Marks, a man whose brilliance on the stock market should be challenged by no one, least of all me. But I think what you've got to watch for here is what brings about the reopening, okay? I think the best thing that could happen to the market would be the announcement or discovery of a treatment for the virus. If they came out and said, we have XYZ and it appears to be effective and it limits the fatality rate and makes it more of just a chronic but treatable issue. That would be the best. The second best would be a vaccine. The reason that would be second best would be it would take months to become truly effective. The treatment would be something you'd be able to see happening next week. That would inspire people to say, okay, this is not as fatal as it looked. I can go out again. I can start spending. I can start to do whatever I want. So, and then finally, the one that we've been talking about recently, and that is the new claims of contagion are cresting. That's good, but that's the one that everybody's talking about, that you want to be careful of reopening too soon and having a relapse. So I am not of a V-shaped rebound. I am more of certainly a U-shape, probably even an L-shape, because I think people, even if you open all the bars and restaurants or people or movie theaters, are people going to flock there if the disease is still around? So I think there will be some hesitancy. So first of all, if you got an overnight note that there was a treatment, I think the market would continue a rally that would open your eyes greatly.
Art, Bob Pisani here. It's so great to hear your voice. We've spoken on the phone many times, but it's great to have you back on the air with us. It's been a long 2 months without you, my old friend. You talked about you're more in the L shape than the U shape camp. I wonder if you think the market's in the right place right now, that it's pricing this in correctly, because from the start of the problems really was the weekend of the February 21st or so. We dropped 1,000 points from February 21st to the bottom on March 23rd for the S&P 500, 1,000 points. And since then, we've regained essentially 500 points of that back. So we've regained 50% of all the losses that we've had. Does that feel right to you, given what you were saying, that we're essentially in an L-shaped situation and this may take a lot longer than people think? Is the market priced right now, given those facts?
Yeah, no, I think it is right. As I said in the beginning, we came in this morning, we had about a 50% retracement. Historically, that's what traders expect to see. Now they thought they would see the market become a bit more challenged as where it was going. Instead, we got the surprise from the Fed, and with the Fed ready to be all in, that got them a little bit excited, and that's why we're having this rally. Secondarily, you're getting a minor boost from a supposed agreement on cutting back oil production. I'm of the skeptic group that thinks that the drop-off in demand is so sharp that there is very little that the producers can do to cut the production back to meet it. So I think oil may try to rebound here a little bit, but I think it's suspect. I think the 50% retracement, Bob, is probably in order with certainly with a U-shaped rebound. I don't know if it's fully with the L-shaped, and we'll have to see where we go from here. The key is if you can get something to treat this disease, the market can continue to rally very sharply. If instead you're going to just hope for the disease to calm down, that's going to raise some questions.
Let me just ask about the floor of the New York Stock Exchange. As you know, your beloved floor has been closed temporarily while electronic trading continues. I'm wondering if you can give us some thoughts on how you felt about the closing of the floor, first time ever, while the markets remained open. And second, when do you think it might reopen, and what would it take? We need coronavirus testing going in the door. What's it going to take for everybody to feel comfortable to get back to work at the NYSE floor?
Well, I certainly would like to see it reopen. I think we're missing certain aspects of the market. And, of course, having been on that floor for 60 years, it not only has great memories for me, but ways in which one can read and interpret the market. And I would like to see that happen again. I think that you're beginning to see the feel for traders thinking you need the market. In fact, you had, even after the market was closed for the virus reasons, they had to make a brief exception and open an IPO with a few people down there. They got an exemption from the SEC so that they could have people physically there for the opening of the stock. And I think that represents the value that we humans can add in some critical and strange moments. So I would love to see it reopen. I would like to see it reopen as quickly as possible. The cause for shutting it down was health-wise, so you can't argue with that. All the philosophy in the world is difficult to argue against health-wise, but assuming that's the case, I would like to see the floor open again. I would like to be back there chatting with you guys and maybe adding a little bit to the nuance of what's going on.
And we'd like to have you back there, too. Art, let me just follow up on Carl's question on the Fed. Powell said this morning there is no limit to what they can do. That word, no limit, really resonated with a lot of traders, at least by what I was getting, the comments I was getting. Not only are they buying corporate bonds, corporate ETFs, they're buying high yield, they're buying munis as well. We used to call this Japanification of the global markets. They're not buying equities yet, but I'm wondering if you could react to that. Essentially, we are going the way of Japan here. Do you think that this is a good way to go? Will the Fed eventually buy equities as well? And remember, in Japan, the bank there, central bank there, owns the substantial portion of all ETFs and about 5% of equities. Are we heading in that direction here in the United States?
Well, I certainly hope not, and I don't think so. I think what you're seeing here is a Fed that is addressing a problem that's usually not one that the Fed faces. The Fed comes in when you're having major economic recessions, and that usually means large segments of the economy, whether it's the energy group, the automobile group. It's when large corporations begin to suffer things. It's when the government comes in and tries to bail out the automobile industry. What you're seeing now is Mr. and Mrs. America. Small business is in trouble. The government has shut down the restaurants and bars. You know how many bartenders and waiters and busboys and whatever are out there, and that's why the fall off in employment was so precipitously large and it happened so quickly. So the Fed is addressing a cutback in the economy like nothing it has ever seen before. So it is broadening out the aspects that it will make money available to. It's going to try and get money to Mr. and Mrs. America, as well as the big shots, the finance companies, the large industries. And that's why it is something different. Therefore, I do not see it going in a manner as Japan did, buying equities or buying ETFs. I think what they're trying to do, as well as the Treasury's newest proposal, is to get money in the hands of Mr. and Mrs. Small America, and to see if that works. And I think that's where they're going.
Finally, Art, on a personal note, I tweeted this morning, we missed your entire Easter tie season, but viewers will want to know, how are you? And are you prepared at some point to hop on a camera, a laptop, and do a Zoom call with us?
Yeah, I think I may be getting there. My son, who has more technological background than I do, was talking about getting a remote cam. I don't know if America can stand to look at this sorry old face again, but we may be ready to do that. I certainly miss it. I miss you guys, and I miss the action, and I want to get back there as soon as possible.
Feelings mutual, Art, and we are just glad that you were on the mend. It is great to hear your voice. Bob, thanks as well.
Keep up the rehab, Art. Keep up the rehab.
Yeah, I'm talking to a doctor about applying alcohol liberally, but I haven't gotten permission quite yet.
Bobby Vans will reopen eventually.
Art Cashin. John?
All right, it's great to hear from Art. And after the break, former Twitter CEO Dick Costolo will break down tech's response to the virus. We'll be right back. Stay with us.
Get social with TuneIn. Follow TuneIn on Facebook, Twitter, and Instagram to discover what's happening in the app and around the world. Be the first to know about upcoming games and the hottest new music. Follow @TuneIn and always be in the know.
Given all the extra time spent at home these days, are you using TuneIn in all the ways you could be? With hundreds of compatible devices, including smart speakers like Sonos, Bose, and Roku, and smart assistants like Alexa and Google Home, there's always a way to listen to the audio you love. Go to TuneIn.com to discover all the ways to listen.
Want to know a great way to discover the latest and greatest sports audio on TuneIn? It's easy. Just make sure push notifications are enabled on your phone to receive recommendations of sports talk radio and podcasts, along with important breaking news updates.
Want to know a quick, easy way to see if your favorite podcasts have a new episode available? Just go to the home screen on your TuneIn app to see the latest editions under the Your New Episode section. Happy listening.
Not all heroes wear capes, but most wear tights.
And here we go, now it's underway. Cover on Rowan, wait a second.
Keep up with everything happening in the wild world of pro wrestling with a TuneIn podcast. For expert analysis of the latest WrestleMania, turn on the WWE podcast or listen The Steve Austin Show for no-holds-barred conversations with wrestling's biggest personalities.
It's good to be here tonight. It's an empty building.
For these and more, search sports and scroll down to the world of wrestling.
You love listening to ESPN Radio live on TuneIn, but did you know you can also listen to favorite ESPN shows on demand? Get the latest takes from Stephen A. Smith, Dan Le Batard, and Garlic and Wingo when it fits your schedule, and listen to episodes of Pardon the Interruption.
Pardon the interruption, but I'm Israel Gutierrez, and I love hosting the show with my humble...
Around the Horn and Highly Questionable as podcasts anytime you want. Search ESPN to see all the podcasts on TuneIn.
Faluka!
We keep getting the same... This is Dr. Sanjay Gupta. Join me for CNN's new podcast, Coronavirus, Fact versus Fiction. We know you have questions. We want to help you find answers. And send me your questions on social media at Dr. Sanjay Gupta.
Luca out here, Second one.
Make sure to search and listen on TuneIn today.
3 of 4 same players.
If we get our act together countrywide, and if the compliance is very high, and that testing, including some innovations like the self-swab that our foundation has driven, if those get into place, by early June, we'll be looking at some type of opening up.
That's Bill Gates this morning with our Becky Quick, striking a relatively hopeful note. Of course, he himself and the Gates Foundation spending $100 million on coronavirus response. Let's bring in the former CEO of Twitter, the co-founder of O1 Advisors, Dick Costello, talk more about big tech's ability to play in the response around the world. Dick, it's good to have you with us. Good morning.
Thanks. It's great to be here as always, even in this altered format.
It is a little bit different for all of us. How would you gauge tech's response both on a corporate level and a personal level? And in what areas do you think they're going to have the most efficiency, whether it's on protective gear, treatments and therapeutics, vaccines, and so forth?
Across the board, the answer to the second question is across the board. On the first question. It's just been it's been impressive.